Learn how to day trade. Chapter 2, risk management. So some of the things today that we're gonna be talking about is choosing strong stocks. We'll be talking about the mindset of successful traders and their risk. We're gonna talk about managing risk, capping losses, your statistics, profit loss ratios, revenge trading, fear of missing out, also known as FOMO, balancing your risk, and improper position sizing. So why is risk management so important? See, risk management is very critical to trading stocks. Without it, you will not succeed. I guarantee you that you will not. If you don't take risk management into account, you're going to blow your account at some point. Majority of new traders not using risk management will blow their account at some point. Understand that the inability to manage risk in psychology is two of the leading causes for failure as a day trader. So when you're looking at the fact that they say 90% of day traders fail, well, 90% of them fail for two of these reasons right here: not being able to manage their risk and a lot of psychology issues. So once you learn how to manage your risk, then just know that you're on your way to becoming a successful trader. And that's the goal, right? Choosing strong stocks. When evaluating risk management, you always have to consider your stock selection. Understand that every stock that you trade is not going to have home run potential. It's just not going to happen. Some stocks are going to make really big moves, and then some will just give you a few pennies a day. Our goal is to look for the strong stocks that are making really big moves or have the potential to make those big moves every day. You definitely don't want the stocks that are only going to trade pennies. I only choose the stocks when I'm trading that are on my scanners and watch list because those stocks have good volume and plenty of other traders are buying and selling these stocks, which gives it the potential that you'd like. Weak stocks always make weak moves. Strong stocks with volume are the ones you want to choose every day. So let's talk about successful traders' mindset and how they think about managing risk. Understand that successful traders think about risk knowing that it's a business, whereas people who gamble only think about the profits. So ask yourself, are you in this to be a successful trader or you want to be a good gambler? Some of the things you're going to have to ask yourself is, how much am I risking? That is a question that everyone must answer and ask yourself before you enter into any trade. You got to have a plan because without a plan, you're only going to plan to fail. So know how much you plan on risking before you enter in any trade. Don't just enter into a trade and then start planning afterwards. That's just not smart at all. All successful traders always ask themselves, what's my risk? Do I have a mental stop, or what should my hard stop be? That's the way you got to look at it. Understand that mental stops can be challenging, especially if you're still working on your psychology. And even, when you've mastered majority of your psychology, it sometimes can be difficult. So all new traders definitely need to set hard stop orders. Don't just get into a trade and then when it goes really, really bad, you're looking at the computer and your emotions have kicked in and you're hoping and, maybe praying that it's going to come back, because a lot of times it won't come back, and if it does come back, do you want to set yourself up to be thinking that way? You don't want to set yourself to think that way, because in the long run, more times than not, you're going to fail. So let's talk about risk. Risk is the amount of money you can potentially lose in a trade. It's important we keep this in check. Make sure you have a set risk and max loss limit on a day. New traders take a loss, then keep trading. Then they take a loss and they keep going and they keep going. But you got to remember that all these losses and commissions, they add up. From my history, in my trading, I've always learned that if I take 3 trades and I'm red on all 3 of them, then it's just time for me to stop for the day, because guaranteed that when I take that 4th trade, I'm going to be red on that one too. Or, maybe if I take that fifth trade, I might not be red. But you know what? You can't take that risk because, once you realize that from your stats that you're red, 3 trades like I am, or maybe it's 2 trades for you, or maybe it's 5 trades for you, whatever that your stats tell you, you have to shut it down after that, because more times than not, you're going to have a bigger and bigger losses just because you don't want to stop trading. So if you take 15,000 shares and you're risking 10 cents on each trade, that's $1,500 that you're risking to lose. So you need to make sure that you plan on making 20 cents, which is 2 to 1. That's going to be $3,000. So if I'm going to risk $1,500, I need to be making double that. So that's what 2 to 1 profit loss is, and that's a profit loss ratio. So whether you're taking 15,000 shares or 150 shares, your profit loss ratio has got to be consistent, and they got to be sustainable. You have to make sure that however many shares you trade, it doesn't matter. If you're going to risk 10 cents or 20 cents, make sure that that's what you're risking. But on the reward side, you have to make sure that you're going to gain double that. So we'll talk about cap and losses. So what if your losses were only $10, but your winners were $90? When you think about it, you wouldn't have to be right that often to cover your losses. If you were right just 10% of the time, you break even before commissions. Remember that trading is just like riding a bike. You're going to fall. It's inevitable. Everyone's going to fall. So at some point, when you do fall, you have to know that what happens over time is you're going to get better, you're going to get better, you're going to get stronger. But understand that taking losses is a part of trading. There's not a trader out there that doesn't take a loss. So the most important thing is to control your losses and make sure that your losses don't get bigger and bigger. And once you can start to control them and you get your losses smaller and smaller, then you can have a great career as a trader. What you stand to lose. Always know what you stand to lose. Not knowing what you stand to lose will put you in a very, very bad position. I've seen it time and time again. Always know your max loss and your potential profit target before you enter a trade. If you don't know these things, then your risk is increased and then you're just gambling. And that's not what we want to do. You don't want to gamble. If you want to gamble, go to the casino, put it all on the table. I promise you, your luck just might be a little bit better. Who knows? So when I talk about max loss, I mean, well, during the daytime, if I might take 2 trades and my max loss might be $500 on a day. So what that means is I don't want to lose more than $500 during the daytime. Like if I lose more than $500, I need to cut it off. That's the max that I'm willing to risk during the day, every single day. So whatever your max loss is, whether it's $100 or $50 or $150, that's the amount that no matter what happens, when you get to that amount, it's time to shut it down. You got to look at this like it's a business, because if you don't know your numbers and you don't keep everything in check, what's going to happen is your losses they're going to accumulate. They're going to accumulate really fast, and before you know it, that's another way that you'll blow your account. So it's all about risk management. You have to manage your risk. You have to know your max loss. You have to know that you're taking a minimum of 2 to 1 profit loss. And you definitely need to know exactly what your plan is before you get inside any trade. So you need to always keep up with your stats, especially in the beginning. As an experienced trader, you might not keep up with them as often anymore. You might stop keeping up with them, but in the beginning, it's really important to keep up with your stats, because you need to know exactly what you're good at, what you're not good at. You need to know during what time of the day are you most successful at? What time of the day, do you not do very well at? So these are things that you need to know, because the market is not the same the entire day. In certain points, it's really, really volatile. So are you better when it's very volatile? Or are you better when it's less volatile? Are you better, at the end of the day, during lunch hour, or you better when the market first open and there's a lot of orders going through. So you need to know these things. In order to know this, you have to keep up with your stats. Whether it's on pen and paper, whether you decide to buy a service and journal your trades, and those services that you get, they'll keep up with everything for you. Some of those you can just import the trades right to them, and they'll give you all the stats. Some of them are really good. If you need to know some of those, just hit me up and I'll give you the names of those services. So other things you gotta remember is, your average winners versus losers, and of course, what time of the day that is. Are you better trading to the long side or the short side? So when you know these things, it helps you work harder and harder to improve your ratios and become a better trader. So, this has everything to do with risk as well, because when you don't know these things, you're just trading, Eventually, maybe you'll end up getting it, but if you have these stats, your learning curve, it can short drastically. So just knowing that, some of the things that you end up learning from your stats, like you'll end up saving a lot more money in the long run, because you can cut this a lot shorter, cut your losses shorter, and the things that you're not good at, you'll cut it a lot shorter faster than what you would if you had nothing to look at. So 2-to-1 profit loss ratio, that's the most aimed for ratio in trading. I usually aim to take trades that only give me the opportunity to double my risk. So if I risk $100, I look to make $200. So that's what 2-to-1 profit loss ratio is. Always ask yourself before you trade, is this a 2-to-1 profit loss ratio? You need to know these things. You got to know them. When the profit window is much larger, then the chances of you capturing a winner, even if you don't get the best entry or exit, is greatly increased. So meaning if you have a window profit of $1 or $2, well, sometimes it doesn't really matter as much your entries and exit at that point, because you're going to get 2-to-1, 3-to-1, maybe even 4-to-1. That's very, very possible. So, you want to look at trades that at least have that 2-to-1 or 3-to-1 or 4-to-1. So that actually goes to the next question that, a lot of people end up asking me is, can you actually have a 3 or 4-to-1 profit loss ratios? And of course you can. There's going to be setups where you risk 20 cents to make $1. Just understand that every trade isn't the same, and even though we look for trades with big windows and trades with potentials to give you a couple points, that doesn't happen all the time. It doesn't happen every single day. So having patience, you have to have patience. That's part of risk management. That's part of your psychology. Okay. But understand that, for the trades that do have those big windows, great, you capture those moves, and you definitely make sure that, your risk management is positioned correctly. And when it's not, you have to make sure that you at least do your homework. At the minimum, you need to be looking for trades that are 2-to-1, not 1-to-1. I don't want to risk 10 cents in order to make 10 cents, But, I want to risk, 10 cents to make 20 cents or 30 cents, So let's talk about revenge trading. A revenge trade is a reaction to one or more losses. Once a trader loses money, they think that the next trade can bring back all the losses and even more. This mentality put them in a bad position because according to your stats, at some point you're red and you're going to be red for the entire day. Revenge trading brings a mindset that makes you think the next trade will be good, or, the next trade will be good, instead of just accepting your red day and not digging yourself into a deeper hole. You're trading because, you're like, oh, well, you know what? I got to make up for that loss. I got to make up for that loss. Like, I need to get all of this money back. So you find yourself revenge trading, and you can't do that. The market doesn't have any feelings. It's going to hit you. When it hits you hard, it's going to hit you. So you got to accept your loss. Like, don't continue to trade, and understand that, like, everything in the market, it happens for a reason. Like, these things are not happening for no reason at all. And so the market doesn't care how you feel for the day. It doesn't care, if you forgot to take your meds. It doesn't care, if, you only have, $500 left in your account. It doesn't care what you have going on. You need to understand that. So when you come to the market, you need to be prepared. And when your loss comes, accept your loss. And you got to walk away from it, When I have red days, sometimes I'll sit there and I'll continue to watch and see what's going to happen. But I know 9 times out of 10, when I'm red on 3 trades, I'm going to be red, for the rest of the day. So I stop myself because I'd rather walk away with a smaller red day than a really large red day that's going to take me a week or longer to come back from it. Fear of missing out can be a huge motivation for you to take trades that you shouldn't trade. Because you're afraid to miss out, you end up getting into a trade at the wrong time, and this alone isn't good. These are emotions that you must control in order to become a successful trader. So remember that once you make one bad decision, it's usually the start of more bad things to come. Yeah, everybody makes mistakes, but you don't want to make one bad mistake and then turn it into 2, into 3. You don't want it to become a domino effect. Also, remember, fear of missing out it sort of has to do with revenge trading too. A lot of revenge traders, they feel like they're fearful of missing out on the next big thing, that's going to make them green on a day. So they go and jump into a trade without doing proper risk analysis on their trades. They don't check and make sure that their profit loss ratios are there, or their technicals is there. They don't have a plan. They just hop in based on what they see, and that's usually always going to turn out really, really bad for them. Yeah, sometimes you might get lucky, that's fine, but we want more times than not for you to be successful. So remember that. And also just know that you don't have to trade. A lot of traders, they sit there at the computer and they feel like they have to trade. You don't have to trade. You're not missing anything. Yeah, you might miss, a stock that made a large move today, but understand that there's 365 days in a year. So what that means is, no, there's not going to be 365 trading days in a year, but you're going to get hundreds of days to trade. So what you miss today, you can get it tomorrow or the next time that they do make that move. But you have to tell yourself, this is how you work on your psychology. You tell yourself, you know what? I might have missed out on that move. That's fine. But tomorrow there's going to be a different move, or next time I'll get another opportunity. Don't tell yourself that, oh, this is the only time I'm going to make money, because that's not true. There's going to be plenty more times that you're going to be able to make money in the market. So don't feel like you have to take trades because you're sitting at the computer, and don't feel like that you're missing out on anything, because you're not. Remember, once you put yourself in that mindset, it's going to be really hard to come out of it. Improper position sizing. So you have to adjust to the size of your account. So if you have a small account, it's not good for you to be using all of your buying power on, a single trade. Honestly, if you have a large account, you shouldn't be using all your buying power on one trade also, because these are things that help you blow your account a lot faster. And just think, if you're only able to take 300 shares with all of the buying power that you have in your account, well, if you end up losing on that trade, well, since you use all your buying power, whenever you see something else on your second trade, you can't buy 300 shares. So that lessens your chance of being green on a day, and that lessens your chances of making all that money. Whereas if, in your account, you can take 300 or 400 shares, we'll just say 300 shares. If the most you can take is 300 shares with your buying power, well, you might want to take, 75 shares, and know that, if you're red on that, you cut that loss really, really fast. Give yourself a chance to still be green on a day. Another thing is you have to make sure that if you do use all of your buying power, which I never ever recommend, just make sure that you take A setups. And when I mean A setups, I mean these are setups that you've seen time and time again that has the better potential to make the move that you think they're supposed to be making. And those are A setups. You want to make sure you're trading clean setups that you've traded before, and you pretty much know what's going to happen. Of course, you still have to set your risk management and put that in place, because without that, you're gonna put yourself in a bad position. So A setups in strong markets is just always the way to go. There's lots of times where I take larger position trades, but I usually do it only on A setups. When there's B setups or C setups, I'm not going full size in it, because I know the chances of them making the moves that I intend them to make, it's a lot lower for me. So A setups have a higher percent chance of you making the move that you intended to make. Let's talk about balancing your risk. Let's talk about balancing your risk. If you take 10 trades and you risk $100 on 9 of them, and then you risk $10,000 on a 10th trade and lose, you traded with a 90% success rate at the beginning, but still become a loser at the end of the day, because you didn't balance your risk across all your trades. So you want to consistently trade the same amount of shares, the same amount of money that you're risking on every single trade. You have to do that. New traders, they always tend to have winners on 100 shares, and then immediately increase their size, to 200 or 300 shares, because they won on 2 or 3 trades during the day, and then when they lose on that bigger trade, it's not balanced at the end. So it's okay to go heavy or go light, but you got to balance your trades. If you're gonna do $100, do $100 risk the whole entire day. If you're gonna do 100 shares, do 100 shares throughout the entire day. The point is to not blow your account. And if you end up blowing your account, you got to take these things into consideration. This is how you're gonna prevent yourself from doing it 2 times or 3 times. So in the mornings, usually I trade with larger size, because it's a lot more volatile, and you can get the moves that you're looking for. And so I can trade with bigger size, knowing that I have a bigger percentage of making the move that I wanted to make. And then in the afternoons, I might take half the size in order to not give away my morning profits. It's very, very important to not make the money that you want to make in the morning and then just give it all back in the afternoon. So that comes back to your stats too. You got to know your stats. You have to know them, because your stats, this is the things that they tell you. They tell you, well, Eric, you're pretty good in the daytime, in the morning, but during lunchtime when you trade, you're only guaranteed 50% of the time to make winners. So these are things that I have to listen to. You have to listen to these things. They're telling you that. So I'm not gonna go full size during lunchtime when a lot of traders are away from their computer and they're not trading during this time. No, I'm gonna sit back. I'm gonna either watch the market. I'm gonna take a lunch. I'll go take a walk or do whatever I'm gonna do. But I'm not gonna sit there and trade, because I know that the odds are against me during that time. Let's talk about some things that you can do today. So some of the things that you can do today to help you get better at managing risk is, for one, you can go ahead and start taking trades. So whether you're trading live or in a simulator, let's go ahead and practice setting live stops. So whether you are trading a stock and you want to get out of a trade live, with a mental stop that you have in mind, go ahead and start practicing that. If you have to set hard stops, go ahead and start practicing setting hard stops. You need to be really good at this. It's all about managing risks. You don't want to blow your account up. Remember, if you find yourself struggling to take the trade off, you need to always set a hard stop. You have to do whatever it is that you have to do to succeed in this business. Understand that some of the best traders in the world, they set hard stops too. And even every once in a while, you'll catch me setting a hard stop. I might have to walk away from the computer. That's what this is for. I want to manage my risk, whether I'm sitting at the computer or I'm away from the computer. That's what this is for. It doesn't mean you're not a good trader. It doesn't mean anything. You just have to be good at setting stops regardless, because you have to manage your risk. Okay. You don't want to let your trade blow over or go past the amount that you managed for. So in the very beginning, when I first started trading, I used to set my max loss to 10 to 20 cents per trade. And, that's something that you should have a really good habit of, because you can always reset if things are not going your way in the beginning. Reset. And if you're right, it will come back. Also, never, ever, 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 ever take trades that don't have a 2-to-1 profit loss potential. It's very important, okay? Okay, so if you have any questions, you need help, anything that I can do for you, feel free to reach out to me, whether you're a member or you're not a member. Just know that you're not alone, and I'm here to help you. My email is eric@selfmadetrading.com, or you can visit us at www.selfmadetrading.com.